In this video, we're going to talk about the MACD swing trading strategy for currency pairs. Stay tuned. Hey traders, a very warm welcome to you. Okay, MACD on the screen. This is a swing trading strategy. However, you can probably use it on a lower time frame, but just expect, as always, with the lower time frames to be pinged out on noise more often than not. Not a bad thing to use as a filter or kind of a precursor for another strategy, but in its raw form, we're using it here on a daily chart, and you can probably get away with the 4 hour. Currency pair wise, Euro US dollar, JPY, all the big players, and in fact, this is probably going to be good for pretty much any market. Cautious of stocks because of the gaps on the daily, but this is the kind of concept of this is something that's really the foundations to use and add something else to it. We're going to talk about a full strategy anyway with this. So I've got MACD on my chart at the moment. I've got the fast length set to 12, the slow length set to 26, and the smoothing set to 9. So these are my default settings on my chart. So the theory of this is very, very simple, very, very basic. And like I say, I think you probably need a couple of extra layers of trigger behind this, but the concept is kind of good. So the concept of this is that you always trade when you get divergence. Now, what is divergence? Divergence basically means, hey, if we're getting a new low in price, for example, this Euro US dollar chart on a daily time frame, we've got a low here, and that's a low on our MACD. We have a low here, new low in price, new low on MACD. Now we have a new low in price. But here we have a higher low in MACD. That is a divergence. So whenever we see that, we are going to go long. Now, the strategy I researched tells you you're going long and picking out a candle. I think that's a little bit too finite. But fair enough, if that's what it says to do, then it's something to look at. So in other words, you're looking for something like a tail to the downside, maybe a bullish engulfing if it's a long trade, something like that. Go and check out the kind of candlestick patterns that I've talked about before in previous videos if you're unfamiliar with those, or give it a good old Google. So either that, or you trade when you get the moving average, so the MACD crossing over, so the fast line crossing the slow line, so that gets you in long here, and then you come out as you kind of make a high, or as you cross below the zero line here, or you kind of hold it for a longer term strategy that you've got. I think that's very valid. So just to recap, you get the low here in price, the low, the low, the low. You're not interested. All of a sudden you get a low here in price. MACD doesn't go to low, so you go long on the crossover around here. It gets you pretty good. Now you've got to have a bit of a leap of faith here, and obviously your stop loss is probably going to be under the last swing low of price or last swing high if you're going short. And then targets, do you want to kind of hold it for new highs? I wouldn't waste this. I mean, I said here you come out if you're going above zero, but let's not forget, guys, if you're putting all the effort in and making you're putting the risk on the table, made the market pay you for being right. There's no point discarding something if you're potentially on the end of a monster reversal. If you find yourself buying something that you never know, obviously the heat at the moment, but if potentially you're at the low of a multi-month move and you're a swing trader, it might be worth just hanging on to it and saying, I've got a pretty decent entry here, it's gone my way quite nicely. Do I want to just grab a bit of money off the table, or do I want to kind of leverage on this and hold it and let this market pay me for being so patient and being right? In actual fact, in this example here on Euro US dollar, that would have paid you very, very nicely. Let's look at it from the flip side, from the long side. So we start making new highs in price. We start making new highs in the MACD, new high here in price as we've broken through that resistance level. The whole thing's just kind of turned and shifted. Notice how the MACD shifts from doing a lot of work below zero to now doing a lot of work above zero. So new high in price, new high in price, new high in MACD, new high in price, new high in MACD. Does that really count? Probably not, because it's quite flat, but if you've spotted that, then I see what you've spotted there. But now we get to a case where, hey, we have a new high in price, but MACD isn't even trying. It's rolling right over, and it's crossing over, and the fast one's spending a lot more time below the slower. So the theory is now that you're going short on the cross, which is about here. Where does that put you? It puts you short pretty much near the high. like I say, this thing needs finessing. You need to add another layer of criteria into, where you place your stop. What else you do. I mean, just by eyeballing this, sure, some of you have noticed perhaps you can use that as condition 1, and then condition 2 on this particular example could be, hey, when we break that and we've had this, then maybe I'll go short, or whatever the case may be. You get the idea. So this moving average divergence is a precursor for saying, hey, the price isn't as strong as it was the last time it was going to highs. It's running out of puff a little bit, or it's not quite as weak if you're in a downtrend. Consider taking, consider this as a reversal, or at least a decent pullback, and time to go against the herd here and fade this move. So something to think about. Let me know your thoughts about stop loss or trigger criteria for the actual entry in the comments section below. Always interested to hear your comments, guys. So pretty simple one, pretty basic one, but nevertheless, can be quite powerful and give you some kind of hints that potentially there's a good reversal coming up in the markets. Anyway, guys, take care. Good trading. See you in the next one. Bye bye.